60% of every mortgage in Canada renews between now and the end of next year, the biggest renewal wave in this country's history. The Bank of Canada says if you're locked in a 5-year fixed around 2%, your payment is going up 15 to 20%, and most homeowners will sign the first number their bank sends them. Could this video help cut that number by almost $500 a month? For a lot of you, yes, and I'll show you the exact math. I'm going to walk you through the 3 things to do before you sign the renewal. 3 things that letter will never mention. And the first one, it didn't even exist the last time you renewed. My name is Raghav Manchanda, and I'm a licensed mortgage broker who reads many of these renewal letters every single week. And here we go. So thing number 1, and this is the new one, you can now take your mortgage shopping without requalifying. Since late 2024, if you move your mortgage to a different lender at renewal, same balance, same amortization, what we call a straight switch, you do not have to pass the stress test again. OSFI killed it. Before that, people felt stuck. They used to say, I can't qualify anywhere else at today's rates. I'll take whatever my bank gives me. That excuse is gone. You can shop. Why does this matter in dollars? Because the rate on your renewal letter is usually the bank's posted rate. It's not the market rate. I see these letters every week. Real market 5-year fixed rates right now are lower than what your letter probably says. And renewal letters routinely come in 0.5% above what you can actually get. So on a $400,000 balance, 0.5% is roughly $150 to $200 a month. Over a 5-year term, that's $10,000, $11,000, $12,000. And here's the part people miss. You don't even have to switch to win. Now, a while back, a homeowner sent me her renewal letter. Her bank's offer wasn't terrible, and honestly, a switch wasn't going to beat it by that much. So I didn't pitch her one. Instead, I told her exactly what to say to her banker, the competing rate to quote, and the one question to ask. She called them. They dropped her rate on the spot. She never became my client. She didn't need to be. And that's the point. The moment your bank knows you know the market rate, sorry, that's the rate, becomes let me see what I can do for you. But that leverage only exists before you sign. Sign the letter and the leverage is 0. One caveat, lenders are still picky about income documents. So a switch goes smooth when you start early. Hold that thought, the timeline's coming at the end. But for a lot of you, the problem isn't finding a better rate. It's that even the best rate means a payment you can't carry. And that's number 2. And this is where the math surprises people. So the thing number 2 is run the math on your actual numbers before the bank runs it for you. And let me show you what I mean. So picture a 2021 buyer, $800,000 home, typical for BC, 20% down, so a $640,000 mortgage with a 1.9 rate, the payments around $2,700 a month. Renewal day, the balance is about $535,000. You got 20 years left, and renew it at today's rate, and the new payment is about $30 to $50. That's $600 more every month, even steeper than a 15 to 20% the Bank of Canada is projecting. Now watch what a restructure does. Same balance, re-amortized back to 25 years, about $2,850 a month. That's $150 over today's payment instead of $600. Stretch it to 30 years, around $2,570, less than what they're paying right now. And remember the $700 from the start of this video? Here it is. Sign the letter blind at the posted rate, and that payment isn't $30 to $50, it's closer to $3,500. Shop it and restructure it, and you're at $2,850. Same house, same person, almost $700 a month apart. That's what one phone call and one piece of math are worth. So straight talk, because that is where most videos go quiet. A longer amortization means more total interest over the life of the loan. It's a cash flow tool, not a wealth strategy. But breathing room now. Prepay later when rates or incoming cash improves, and that's an actual plan. If you're also carrying a car loan at 8% or credit card at 20%, rolling those in at renewal can cut your total monthly cost by $100. And one more thing, because I see this every month, If the debts have piled up to where even the restructured payment does not fix the stress, the credit cards keep refilling, the line of credits are maxed, then a straight renewal is the wrong tool entirely. That's a refinance conversation, a full reset of the mortgage, not just a new rate on the old one. Different math, different qualifying. I'm doing a whole video on renewing versus refinance next, so subscribe if that's your situation. Now, the point is, these are the choices. The letter shows you one number. It will never show you any of them. But every one of those options runs through two things most people never check. And in whether you're in BC or Alberta right now, that's exactly where homeowners are getting blindsided. This brings me to thing number 3. This is the one that saves people from 5-year mistakes. Stop reading just the rate. Start reading the terms. The prices in Lower Mainland are down about 6% year over year, and it's a buyer's market. Why does that matter for your renewal? Because every flexible option I just showed you, re-amortizing, consolidating, refinancing later, runs through your equity. If you bought recently with a smaller down payment, you may have less usable equity than you think. Find that out months before renewal, not the week of. Then there's the fine print. 2 clauses matter more than the rate. 1, prepayment privilege. How much extra can you put down each year without penalty? Is it 10%, 15, or 20? That's your escape valve if rates drop or your income jumps. And the penalty structure is the second. Some lenders calculate breakage in a way that can cost you tens of thousands if life changes and you need to sell, move, or restructure midterm. A mortgage that's 0.25% cheaper but locks you in with a brutal penalty isn't the cheaper mortgage. It's a 5-year trap with a discount on the door. Here's the frame I give every client. The rate is what you pay if everything goes to plan for 5 years. The terms are what you pay if it doesn't. Price both. So what does this look like as an actual plan? 60 seconds, that's all I need. So here's your plan. About 120 days before your renewal, that's when most lenders will hold a rate, do the 3 things. Shop the switch, run the restructure math, and read the terms. Not just the rate. And when that letter shows up, remember what it actually is. It's an opening bid, not a deadline. Most people will sign the first number they're mailed. Now, you won't be one of them. And if you want a second set of eyes, a renewal review with me costs nothing. The link to my calendar is in the description. Send me your letter before you sign it, and I'll tell you straight if your bank's offer is good. And sometimes it is. So if this video helped you, hit like and subscribe. Renew versus refinance is coming next. And if you have any other questions, feel free to call us or book a call. This is Raghav signing off, and see you on the next one.